In this video, we're gonna get mad about Mad Money and see whether or not Jim Cramer really knows what he's talking about or if he's just the entertaining clown that all of his critics claim he is. Cramer started his career as a professional investor at Goldman Sachs in 1984, before he left in 1987 to start his own private hedge fund. Cramer claims to have returned an average 24% a year after fees for the 14 years that he worked at his hedge fund before retiring in 2001. In the 1990s, Cramer would often serve as a guest commentator on CNBC and also had his own radio show called Real Money with Jim Cramer. And then in November of 2005, CNBC gave him his own show, Mad Money with Jim Cramer. Mad Money is a one-hour show that takes place every weeknight and covers what's going on in the stock market. Cramer offers his insights as well as some lessons and also interviews both CEOs of public and private companies as well as political figures to get ideas about what's going on in the political stage. Viewers can call in and ask questions, and during each episode there's a 3 to 5 minute segment called the lightning round where viewers will call in, ask about a specific stock, and Cramer will tell them whether or not he would buy or sell that stock. In addition to the show, Cramer runs a charitable trust where he offers the buy and sell alerts for every move that the trust makes through CNBC's Investing Club, which costs $399 a year for the subscription. There is quite a bit of controversy around Cramer, with some of it that started when he was running his private hedge fund and some of it occurring during his show. One of the biggest blunders Cramer ever made was coming out in 2008 and saying that Bear Stearns, an over 100-year-old investment bank, was a solid investment and that investors shouldn't pull out their money. Literally less than a week later, Bear Stearns collapsed to a fraction of its value and was acquired by another bank. Cramer's unfortunate call on Bear Stearns would come back to haunt him for quite some time afterwards, naturally, because that was a very big blunder. The other key point of controversy that comes from the show is the lightning round, which I mentioned earlier. The lightning round is only a 3 to 5 minute segment, and viewers call and ask Cramer about whether or not he'd buy or sell the stock that they want. Many of his critics will use this segment of the show as why Cramer is wrong and not good at advising people when it comes to long-term investing. However, when you give opinions about that many stocks publicly, you are going to be wrong a lot of the time. Personally, I've been watching Mad Money since 2006 on a daily basis. That's right, I've seen nearly every single episode of Mad Money since 2006, more than 16 years. So this gives me a lot of insight into whether or not the critics of Mad Money are accurate in how they do their analysis. While I do tend to agree that the lightning round is a bit of an ill-advised segment, since Cramer has to answer whether or not to buy or sell a stock very off the cuff. Even if he knows the stock well, it doesn't give him any time at all to really go into any insight about why he holds the opinion he does. However, the vast majority of the studies that critique Cramer only focus on the lightning round, which not only is ill-advised on their part, you're talking about a 1-hour show and you're focusing on just 3 to 5 minutes of it. If you watch Mad Money for any length of time, you'll hear Cramer give you investing lessons, and he regularly tells people not to buy and sell based on anyone else's opinion, including his own. Cramer encourages his viewing audience to make their own investing decisions and to be active investors about individual stocks. And one of the things that he keeps coming back to is that you should never just listen to somebody else when it comes to your investing decisions. However, many of the critics, including Jon Stewart on The Daily Show, chose to focus only on the lightning round, not watching the vast majority of the episodes. By only focusing on a very small part of the show, you're not going to have an accurate view about what Mad Money's about. And if you only watch a few episodes, you're still not going to know. You have to watch for a longer period of time. However, when it comes to the lightning round, the audience wants this. They want the participation. They want to be able to call and ask about a stock, even if the buy or sell is just a quick off-the-hand comment. Personally, my view is if you're making a decision to buy or sell an investment solely based on the opinion of someone else, you're doing long-term investing wrong. It's fine if you don't want to be an active investor and make your own decisions, but if that's what you want, you should go out and buy a low-cost index fund or hire a financial advisor. If you're trying to find someone like Cramer or somebody on YouTube where you can watch and just follow their buy and sell orders, you are not an active investor, and you would be much better served hiring a professional financial financial advisor. In my 16 years of watching Cramer and my more than 24 years in the stock market, I can tell you that a lot of the lessons that Cramer teaches you from his 40 years of experience in the stock market are valid and valuable. In addition to the lessons that Cramer teaches, some of which are the fundamentals of my own investing, including buying and selling in stages, Cramer interviews CEOs and political figures, which provides a lot of insight and perspective into the investing world. However, it's important to remember when you're watching the show that Cramer does have a bullish bias. In other words, most of the time he will lean toward the upside and sometimes ignore downside risk. And while Cramer does tend to be bullish, when he goes bearish, he is a force to be reckoned with, and he has called many of the biggest sell-offs that we've seen in the last 17 years. In August of 2007, Cramer famously screamed, "The Fed knows nothing," when he was talking about the mortgage crisis that was about to take place just a year later.
And these firms are going to go out of business, and he's nuts! They're nuts! They know nothing!
On October 6 of 2008, Cramer warned that any investor who might need funds in the next 5 years should consider selling their stocks and getting out of the market. At the time in October, the S&P 500 was at $985, and by March of 2009, it had dropped down to $666. If you had listened to Cramer, he would have helped you sidestep a more than 30% loss. There are many critics of Cramer who say that he did the wrong thing by warning people to get out of the market because he scared them and that they didn't end up getting back into the market. And while that might be true and he should have encouraged people a little bit earlier to get back into the markets, he did successfully warn people about an epic crash that was right around the corner. More recently, in February of 2020, Cramer came back from the Super Bowl without seeing the game to warn his audience that the COVID-19 virus, which had only touched down in the United States weeks earlier, was going to be more severe than many thought. If you had listened to Cramer about the COVID-19 virus, you might have been able to prepare yourself for the upcoming sell-off that took place in March and sold the S&P 500 down more than 30% from its highs. I never buy or sell a stock solely based on Cramer's opinion of the stock. However, his show has brought many successful investments of mine to my attention where I did my own homework afterwards and decided to invest in the stocks. In July of 2017, Cramer did a segment on the humanization of pets, which got me into IDEX Laboratories, ticker symbol IDXX. Over the lifetime of my investment, IDEX is currently 5 times bigger than the original investment that I put into the stock. Cramer got me into Nike, ticker symbol NKE, in February of 2012 after he had the CEO on his show. My position is up more than 400% since then. I have no capital left in the position, and each share I hold adds more than $6 in profit to my portfolio's bottom line. I got into Block, which was then called Square, with the ticker symbol SQ, in August of 2016 when Cramer had CEO Jack Dorsey on his show. I bought Block at $11.10, and even after its more than 55% sell-off in 2022, my portfolio position has more than $71.45 in profit added to the bottom line for each share that I hold. Additionally, the investment is up more than 6 times the original capital that I put into the position. Cramer was also instrumental in getting me into my biggest winning position currently, Apple, ticker symbol AAPL. In April of 2013, many analysts didn't think there was any growth left in Apple, but Cramer had done his own analysis and believed there was a lot more upside, so I bought in at $14.17 a share. Since then, I've taken all the original investing capital out of my Apple position in addition to $35.15 per share in profits, and my overall position is up more than 8 times the original investment capital. In 2019, Cramer flipped from being a bear on Tesla with the ticker symbol TSLA to becoming a bull on the stock. His analysis motivated me to do my own research, and in the March 2020 sell-off, I opened my position in Tesla with an initial buy at $111.30 a share. Since then, I am up more than 7 times my Tesla's original capital. I've taken all of the capital out of the position, and I have profits in addition to that. Cramer's lessons also teach investors how to buy into market market panics, how not to panic, and how to be very careful when it comes to buying in stages. Because of some of his lessons, I was able to have the confidence to buy into the flash crash in May of 2010, as well as add to my positions during market pullbacks in 2011, 2012, 2015, and 2018. For me, when I look at Cramer, there are only two kinds of experts out there: those who have been wrong and those who will be wrong. If you think you can find an expert who's never been wrong, you are wrong. As private investors, it's up to us to know ourselves. We need to develop our own investing style, pick our own investments, and figure out what kind of risk appetite we have. No one else can do this for us. It's up to us to figure ourselves out. If you think you want to be an active investor, that's great. But if you're just looking for somebody who you can copy their trades, then you're doing it wrong. It's fine if you don't want to do it yourself, but don't blame somebody else for your own investing mistakes. If you just want to be a passive investor, either hire an investment advisor to do it for you or just invest in a low-cost index fund that tracks the stock market. There's nothing wrong with being passive. The biggest mistake you can make is by being passive but think you're active. You will make mistakes if you don't want to put the time in. However, no matter if you're a trader or an investor, active or passive, you need to learn from others. Find investing sources that you agree with and those that you disagree with to learn more and develop your own investing style over time. If you like this video, please hit like and subscribe. If you want to learn more, check out some of my other videos here. Thank you for watching, and I'll see you in the next video.